Hi, folks. This is Mike Zlatnik, Big Mike, and today's discussion is going to be about UBIT tax implication or consideration when investing into a real estate syndication. Before we dive into that, the usual disclaimer: this is for informational, educational purposes only. Consult with your attorney and CPA professional before making any investment decisions. There's no solicitation of any kind, no advice of any kind is given. So this is purely educational, just some basic concepts to understand what is UBIT tax, how is it potentially generated, what are the risks, and what are the strategies, workaround strategies to solve that risk. So first of all, UBIT tax, UBIT stands for unrelated business income tax. Sometimes people also use the word UBTI, unrelated business taxable income. So UBIT tax is applied to unrelated business taxable income. And typically it happens in real estate when you invest in an equity of a property or a syndication, and there is debt, there's mortgage. So for example, you buy a turnkey property into your self-directed IRA account, and you take a mortgage, and then there is mortgage leverage. And you put 25% down, 75% mortgage. And when the property gets sold and you make a profit, because you had 75% mortgage leverage and 25% equity, and let's just say you generate $100,000 income, in theory, the 75% of that, $75,000, could be subject to the UBIT tax, just a high level. Similar concept applies when you do a real estate syndication. If you invest in an equity with syndication and your IRA investors, to be clear, not you, your IRA, and syndication generates a profit. For example, you invested $100,000 from a self-directed IRA, and 5 years later, the money doubled and you got $100,000 back. For the sake of the argument, we'll leave the cash flow alone. But let's just say you doubled your money and you had 75% leverage, then 75% of the money would be subject to this UBIT tax. UBIT tax is something that's not desired, but technically it is applicable in the scenarios that I described. Many investors have historically either didn't know about it or chose to ignore it. And that's investor's choice. That is between investor, a CPA, and the decision to file the UBIT tax or not. But technically it is due. And the chances of an audit of an IRA account are very, very, very small. So some folks have just ignored the UBIT risk, or they got into deals and they didn't even know about UBIT risk. And when they sold the property, theoretically some UBIT tax was applicable and they just chose not to pay it. Now I'm going to make no comments or no arguments on that, other than chances of an audit are pretty low. And then the rest of the discussion and decision whether to file and pay UBIT tax is subject to an individual investor and a CPA, right? That's just a key point. There are some workaround strategies. The purpose of this video is just to give folks some workaround strategies, what else you can do if you're considering to invest in an equity of a real estate property as a partner in a syndication, or just a buyer of property through as a turnkey property. There are a few options. So one of the basic options is to set up what is known as a blocker C Corp. So simply, your IRA would invest in the shares of a C Corp. It would own a C Corporation. And then the corporation will make the investments. Because C Corporation files its own tax and pays taxes on a corporate level, the IRA would not be subject to UBIT risk. So this technique of a blocker C Corp is one of the techniques that has been used when there is a concern for UBIT and investors would like to still make write the check into the deal, equity of the deal, but they don't want to pay UBIT tax. In a blocker C Corp strategy, the C Corp generally pays a lower tax rate than the UBIT tax. So the argument for a C Corp is just to reduce the tax rate through that technique versus paying a UBIT tax, which is a much higher rate. The UBIT tax rate of taxation goes up to 40%, relatively on a small level of income, over $12,000. And again, I'm not CPA, I'm not giving tax advice. This is my understanding. Things can obviously change in time. Corporate tax can start as low as 15% and typically has a lower upper limit, even if the corporation makes a lot of money. So a blocker C Corp idea is very simple, straightforward. Some folks have used it. There's an alternative technique to consider for investors before deciding whether they want to invest in a syndication or buy a turnkey property. By the way, one of the key points, I put no comments, no merits on the investment decision. That underwriting completely separate. assume at the moment that you like the deal, right? That's the only reason you would consider this. So deal merit, deal underwriting, completely separate exercise. Now let's chat about, there's another, it's an advanced technique. It's not for everyone. Plenty of people will not be comfortable, but you certainly can consider doing it. So what kind of income into an IRA is not subject to UBIT? So the simplest and easiest income into an IRA is interest income. So in other words, when IRA makes a loan or invests into a note or loans the money on a note, the income it receives is interest income, and the interest income is not subject to UBIT. It's the most exempt income, the best income for an IRA is interest income. That cannot be subject to UBIT under any circumstances. Again, not a CPA, but this is my understanding. So consult with your CPA. This is my view of the world, the way I know it today in tax law. So an IRA can make a loan, to a non-prohibited party. So prohibited parties are generally linear descendants or spouse or self. So an IRA cannot make a loan to you, cannot make a loan to your spouse, cannot make a loan to your children, cannot make a loan to your parents. So linear ascendants and descendants are not allowed for self-directed IRA. However, siblings are perfectly allowed, friends perfectly allowed. So if you find a deal you would like to invest in, and you have a brother or a sister or a good friend that you trust, and you want to talk to them and they are open to work with you, or they might like the deal too, and they may want to invest in the deal too. The consideration might be is for your IRA to make a loan to their entity, their LLC, under the terms that approximately resemble projected target returns. So for example, let's say you look at syndication and its target return is 20%, just for sake of the argument, a year. It's the 20%. Maybe the loan is at 18%, slightly below that, but it's a loan. How to structure this, it depends on the kind of a deal, how comfortable you are. But there's a way to structure a loan with some fixed rate and some variable rate. And a loan could be structured with deferred interest as well. It could be a multi-year balloon loan. So if you structure the deal in that manner, and your IRA could loan the money to your friend or the entity of your friend or your brother or your sister, and the entity can make the investment into the deal, combining with their own money or just your capital, the UBIT issue in essence disappears, as that investor, as your friend, your brother, your sister, they'll invest into real estate deal, and as real estate deal generates profits, it'll be subject to tax, but it'll have a deduction, a large deduction in the form of interest expense to your IRA. So that technique is an advanced technique how to avoid a UBIT. Of course, you have to be comfortable with your brother and the sister. They have to be willing to do that, and they have to understand the ramifications to their own tax return, because they're going to file and they're going to have an investment on their portfolio that'll generate K1 for them, may generate some tax benefits for them. They may be able to use depreciation as a side benefit to the investment. Nonetheless, for your IRA that can't use depreciation benefits, depreciation doesn't do anything anyway. So if you invested in an equity of a deal directly, not only you're subject to potentially UBIT risk, but you also can't use tax benefits of the depreciation. But if you do this technique that I mentioned, a loan from your IRA to your friend, brother, sister, their entity, and they invest that money into the deal, might benefit them too from the point of view that they'll get the tax benefits. Number one, the depreciation, and number two, they may be able to make a little money on the deal too. So at the end of the day, this technique is an advanced technique that helps avoid potentially UBIT risk. I'm not advocating for this technique. This is purely educational, just to explain that there are a few ideas out there. If you're concerned about UBIT risk and a syndication, this may be something that you can discuss with your CPA, and with their approval, perhaps this type of technique can be used to write a check into a syndication via a loan to a friend, a sibling, and they'll invest on your behalf. And that is a pretty powerful. As always, chat with your attorney and CPA professional for making any investment decisions. I hope this was helpful and gives you a little bit of a tool in your toolbox before you write the next check into a syndication. Thank you kindly. Until the next time.